Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to briefly touch on the latest GDP release. There's been a lot of negative headlines and it's hard to sugarcoat a 1.6% annualized decline. But besides the huge drag from exports and the fallout from the trade war, there are actually some positives if you squint. We'll explore what that might mean and if it's sustainable, and we'll also touch on why, big picture, this release should have been no surprise, as the trend largely remains unchanged. Tariffs or no, Canada continues down the same path. So let's start with the following chart. Canadian GDP growth slowed sharply in Q2, coming in weaker than expected at negative 1.6% on an annualized quarter-over-quarter basis, following a strong 2% gain in Q1. The contraction in the second quarter was driven by significant declines in the exports of goods, as well as the decrease in business investment, specifically in machinery and equipment. The result was broadly in line with the Bank of Canada's July forecast of negative 1.5% under its current tariff scenario, but details were more mixed than the headline figures suggest. Further dissecting the numbers, we can see clearly the decline remained concentrated in the trade-exposed sectors, and this makes sense. Net exports fell by 8.1% on an annualized basis, and this is, of course, tied to the broad-based fall in U.S. imports after the surge in the pre-tariff stockpiling in Q1. We are choosing to look through this as there are early signs that the adjustment has run its course, with advanced U.S. trade data showing a 7% rebound in imports in July. Excluding net trade and the inventory components, final domestic demand actually rebounded strongly after a weak Q1. Meanwhile, business investment fell sharply, which also is due to the trade woes, but that was offset by the jump in household consumption and the recovery in residential investment. A look at household spending is important, as it accounts for about 54% of Canada's GDP. In Q2, it increased to 1.1% after barely rising 0.1% in Q1. This was driven by higher expenditures for new vehicles, financial services, and food. Critically, household spending also increased on a per capita basis by 1.1% in the second quarter after being flat in the first quarter, as population growth eased. Here's where it gets interesting. Even though the household consumption was a decent print, we're not sure it's sustainable, as it contradicts other indicators. For example, the Consumer Spending Index, which points to weaker consumption in the coming months, as well as the impact of higher interest rates on consumption. Higher interest rates means higher debt servicing, means less money for other types of spending. Now, it's true that debt service ratios have come off their highs, but according to the Bank of Canada's research, no less than 60% of mortgages will need to be renewed this year, 2025, and next year, 2026. And that based on rate expectations in April, 60% of borrowers will see their payments increased compared to December 24. Now, since that research has been published, interest rate expectations have come down a little bit, but it still means a lion's share of people will have higher debt service payments. Another reason we remain skeptical of the consumption piece of the GDP going forward is the deteriorating labor market. In episode 50, we discussed that the unemployment rate held steady at a relatively high 6.9%. But when we strip out public sector contribution, the employment growth has been flat year on year. And there has been a sharp decline in the share of sectors showing an increase over the last 6 months, the worst since COVID. Naturally, this does not bode well for consumption. The upshot to all of this is that despite the shocking headlines, not much has changed. The cyclical issues for Canada remain. It's an economy in dire need of a trade agreement to give businesses greater visibility. Higher interest rates are weighing on household sentiment as well as consumption. And tomorrow, September 5th, we expect the labor market data to point to continued deterioration in employment and other metrics around the labor market. Not to mention the sticky inflation, which will mute the impact of the Bank of Canada's rate cut later this month, something we'll touch on next week. Last week's decline in GDP raised questions about whether or not Canada is in a recession. Technically, a recession is 2 quarters of negative GDP growth. But we think this totally misses the point. Canada's per capita GDP has been flat for nearly a decade, and it is still well below its 2019 peak. Paired with rising unemployment, we think Canada's been in a recession for years. Add that to the ongoing productivity emergency and the high debt levels. All in all, it's not a pretty picture with no quick fix, and surely more pain to come if you are not positioned for it. Well, at least the hockey season is about to start. All right, that's a wrap on this week's episode. Thanks again for watching. Please like, subscribe, and follow for more. And as always, we manage money for families all across Canada and the world.